Hi, everybody. Welcome to Signs of Strength and Signs of Weakness, and most importantly, how to use them. This is the first webinar I'm doing in quite some time, so it's nice to see everybody here. Just a quick reminder that this material is copyright protected. Please don't reproduce this, especially on the internet. Don't post it up there. We have a constant problem with people doing that and other people selling it. So I appreciate it. This is my personal intellectual property. So please don't do that. Also, this is educational in nature. We're not representing any account is likely to achieve profits or you're going to do well or anything like that. Or we're not suggesting you buy or sell any particular instrument. Take a moment to read this through if you have any questions about it. So, and all charting credits here tonight. I think most of the charts are coming off of TradeStation, but there might be a few multi-charts in there. These are the two platforms that I use personally and have been using for quite some time. Both are very good. So, tonight's agenda. I want to start with a few things to keep in mind, some basic things. And then kind of give you a sense of how we're going to proceed here with all of this. We're going to talk about the signs of strength and the signs of weakness, along with other common signs like shortening of the thrust and clustering of closes and that sort of stuff. Signs that are common to both strength and weakness. All right, and many people may have heard of these before, either through trade guide or webinars or reading about it, Tom Williams's books or my work. It's pretty familiar stuff. What's probably not so familiar is how to use these and use them effectively. And so we're going to talk in great depth about that tonight, including how to use them with multiple time frames, which I think is the cat's pajamas when it comes to trading. And you'll see what I mean as we go into it. And then we'll end with some suggestions on how to own this material. All right, so I've got 80 slides in here tonight. Please keep your questions brief and to the point, and do them while we are in the process of talking about a chart. We can't go back, 20 charts to address a question that you're thinking about now. So questions are welcomed. I love questions, but just keep them on topic and keep them and ask them at the time. Okay, some basic stuff to keep in mind. The method is applicable to all actively traded markets. That includes futures, the financials, the currencies, the commodities, stocks and ETFs, and the Forex market. We rely strictly on price and volume. So in Forex, you have to use tick volume, which is highly reliable and a very good surrogate for actual volume, which is in fact not available in the Forex markets. It's applicable to all time frames. What you see on the intraday you will see on the swing, and you will also see on position trades. And we'll go through, you'll see charts in here that range from 5-minute all the way up to a yearly chart and a quarterly chart. And you're seeing the same stuff on all those time frames. And our charting is old school. We do not use candlesticks. They are not necessary for this method. They actually introduce additional information that can be confusing, and so we just don't use it. My recommendation, if you're using candlesticks and you're interested in this method, try it without for a while. Give it a chance to see how it works, and I think you'll be surprised. All right, that's the real basic stuff. Now, when it comes to things that we want to keep in mind with respect to this method. So price action, a lot of people look at price action and trade off of that and think that's all they need to do. Good luck with that is what I would say. Price action is only a part of the story. And here on this chart, for example, we have a spring setup. For those of you who don't know, the market's coming down, it makes a low. rallies to a high. In this case, we come down, we did it twice, which is fine. Nothing wrong with that. But then to set up the spring, we come down generally on lighter volume than when we were coming down before, which this is close to. And we go underneath, we go underneath this last swing low here, but we don't penetrate very much. And we immediately, or within a bar or two, turn around and close back up above the swing low. So that's called a spring. Failure to follow through to the downside after we've set a low, rallied, and then came back down to it. So now, this is generally a very good trade, and we want to buy this. This would be a long trade, and the trade would be for a push up above the 28.50 level, above this last swing high somewhere. Okay, that's the basic trade there. But now let's take a look at this. As we look, we see that we can see that volume is expanding as the market comes down. Okay, this is selling in spades. I understand there's a little shortening of the thrust in here, and it's closing off the low, so there's some buying coming in. Obviously that's there, or maybe not obvious to some of you, but when you get skilled at this, it becomes obvious that there's some buying there. So we look and see what happens on the next move, and that's an up move, and look at what happens. The volume drops off precipitously. It drops right down. There's no demand in there. There's no buying. This is all selling, or mostly selling in here. Buying just can't be found. We come down again, making a lower low here on the swing, and I see volume increasing. Okay? As we rally back up, what happens? Volume decreases. Okay, so we're starting to get a picture here that price and volume are doing something. And this is what we want to pay attention to. Price is only part of the story. We have to add in volume as well. When we do, we can see that volume is increasing again to the downside as we come down. And it starts off, on this swing, we start off with volume picking up. But once we get back up into this area, the 2800 area or so, volume drops off again. Demand dries up. And as we come down again, what do we see? We see volume picking up to the downside. So this starts to help us begin to develop what we call a Wyckoff story. A story of supply or demand, a story of selling or buying, and which is dominant. And when we start looking at this more carefully, we see that once we get into this trading range here, the demand volume, the buying volume, is less than the supply volume. And therefore, this, reorient you here, we're right here at 2650. This spring at 2650 fails. It's not a signal to go short in here. What I'm trying to show you is that a setup, a spring setup, which is a common or a classic Wyckoff setup, to rally up to higher prices, this had no chance because of all the supply that was in there. That's our Wyckoff story. Okay. All right. I got damn this thing. I got a couple of questions coming in. Is this recorded? Yes. You only display closing price. Do you not care about the open? I don't care about the open. It adds information we don't need. If I'm trading intraday and I'm in a rotational day, typically price will come back around to the open or near the open at the end of the day. That's the only time I am thinking about open, period. Okay. Okay, so that's the Wyckoff story, and those are the questions that we had. So now, signs of strength and signs of weakness. These are the ones we're going to talk about tonight. No demand, hidden up thrusts. We'll talk a little bit about up thrusts so you understand what up thrusts are, but I'm not going to focus on them. I will focus on hidden up thrusts. Focus on buying climax, top reversal, and capping the market. The corollary on the signs of strength side are tests and no supply, or corollaries to no demand would be tests and no supply, hidden up thrusts, key reversals on the upside or the buy side, selling climax, two bottom bar reversal, and bag holding. In addition to these, we're going to look at signs that are common to both strength and weakness, including expanding volume in the direction of the trend, shortening of the thrust, effort versus result, clustering of closes, and the first opposing large bar or swing with large opposing volume, opposite to the trend, volume opposing the trend. And these are signs that are common to both. So we'll see them in both when we're looking at signs of strength and when we're looking at signs of weakness or indications of weakness. And what I think will be the most important thing I'm going to convey to you tonight is integrating this and how to use this with the higher time frames in terms of higher time frame market structure, support and resistance, and higher time frame trend lines. This, in addition to the price action and the volume, the supply and the demand, will all go into making a Wyckoff story for ourselves. And I think you'll find, if you work with this, that your trading will improve. All right, so let's talk about expanding volume in the direction of the trend before we get into any of the signs of weakness or the signs of strength and so on and so forth. We often hear that buying occurs on down bars, and anytime a down bar occurs, everybody wants to jump in and buy. That's not true. And that's a misinterpretation of this method. Does buying occur on down bars? You bet it does. Absolutely. But it also occurs on up bars, and it also occurs on, it occurs in different ways. And I'll show you in a minute how it occurs. But in trending conditions, we're looking for expanding volume in the direction of the trend. So if the trend is down in this case, which it is, and volume expands in accord with the progress being made. We're coming down. I got very weak bars in here, all closing on the lows, all making progress to the downside. And I'm seeing volumes coming into the downside as that's being painted here. So it's weakness that we see here, and we confirm it with the next rally, which we see is down, and we have trade opportunities in there. Okay, we'll come back to this chart a little bit later with that. But what this is showing, this and this, says more weakness is coming, and it does come. Okay, so don't get hoodwinked into seeing a high volume bar and bang, we should be in there buying. We should be in there buying if it's a down bar. That's not necessarily the case. In your ES example, it looks like we have to wait to see price behavior for a few cycles. Well, you'll see how we do it as we go along. You do not think of an exhaustion gap as a sign? No, we don't deal with gaps. I'm not interested in gaps. In the waiting may miss out the trade or reduce gain. Yeah, well, come back to me at the end of this presentation and tell me if you still think the same thing, Tom, because I don't think you will. But you come back to me and you tell me if you do. Okay? I don't want to. I'll leave it there. Okay, the same thing is true on up bars, and this time I did it a little differently so you could get a different graphic picture of this. We hear selling occurs on up bars, and well, yes, it does, but if the trend is up and volume is increasing to the upside in accordance with the progress being made to the upside, then it's strength with more strength to come. You can see here, I've got volume is increasing over this, and price is going up. That's good. We get some negativity in here with high volume. Sure, there's selling on there, but look at what happens as we come down. Volume dries up. We start to rally, bang, volume goes up again. We pull back, volume recedes. We rally, volume increases. We pull back, volume. And you can go through all of this. Up here, what do we notice? We're trying to rally, volume is down, and instead of up bars that are closing firm near their highs on the rallies, these are closing on their lows. Look at that. There's a change here coming, okay? So the selling is occurring here, not in here. That's important to understand. Does volume stop the market? And do we buy on down bars? Sure, look at high volume. There's buying going on. High volume, buying going on. Check this out on your own charts. You will see this constantly happening. But notice the volume. Notice the volume we were looking at here. There might be this, or maybe this here is spikes up, but nothing like this, or this, or this. You see these little isolated spikes in volumes, these pops in volumes. That's what's going to turn the market. Whether they're to the upside, whether they're up here to the downside, you know, volume coming in here is actually selling, and volume coming in here is buying. Okay? When you get those high volumes, you want to look at that, absolutely, but not when it's moving in progress, either to the upside or to the downside. I hope that's clear to you. Okay, now, one way to trade this expanding volume is what I call the 6-5 combo, for lack of a better name. I just made it up. The initial condition, this is, I'm going to show you on an intraday, but you can scale this up to a swing trade or a position trade if you like. So a 6-5 combo. If you're doing it on a swing trade daily basis, then maybe it might be a weekly daily combo. Okay, if you're doing it on a position basis, it might be a monthly weekly or a quarterly weekly, something like that. All right, so the initial condition, we're looking for an hourly up bar that has increased spread or range. When we're talking about range or spread, these terms are synonymous. And what they mean is the bar's distance from high to low. Okay, the spread or the range, the spread or the range is the distance from high to low. It closes on or near its highs and has volume that's increased or is sustained, similar to what we were talking about with those first two examples, right? Low volume will disqualify it, and sudden abnormally high volume will also disqualify. For low volume, we often use this little thumbnail, this little model, I guess we would say. Volume, the current volume is less than the volume on the previous two bars. That's not a rigid rule, but it's a good one if you're just starting out. Okay, it's not a bad one but just remember it's not rigid. So we allow that hourly bar to close, and then we shift to the 5-minute chart. And we're looking for two things, confirmation and entry. We're looking for no supply, tests, key reversals. These all confirm the strength of the hourly, and they also offer entry to our trade. Okay, I'm going to talk about no supply and tests and key reversals in detail. This is more kind of giving you the overview of a trade setup, and then you'll learn more about, if you don't know about no supply tests and key reversals, you'll learn about them in the course of this webinar. The target for this would be next resistance, or if weakness enters, obvious weakness enters. And you can reverse all of this for short sales. So the initial condition, you're looking for an hourly down bar that's increased spread or range, closes on or near its lows, has volume that's increased or sustained. Then we shift to the 5-minute chart for confirmation and entry. Now we're not looking for no supply tests and key reversals. We're looking for no demand and hidden up thrusts. Okay. All right. So let's take a look here. So here's an example of the 65 combo. Here's the hourly chart. Let me get the pointer here. Here's the hourly chart, the 60-minute chart. This is the other day. This is the 5-minute chart. So we are, and I'm picking this right near the open because so many traders are fearful of trading the open. And what I'm going to show you here is a way to do it. This is a great trade setup. I love this. This is my favorite one. Okay, so this is yesterday. This is the session break for yesterday. You can see the high volume in yesterday. So we closed down here, and so far we've gone up above yesterday's high in the overnight. This looks like it's starting. This is in the Asian and then the European session. And now we're getting close to, you can see 9:30 starts here on the next bar, and I'll show you where this ends in a moment. But we are getting some increased volume. Now, we're looking for increased volume relative to the last several bars here, a bunch of bars, okay? You can see we've broken out here and pushed up, and we have increased volume. So now we look on the 5-minute for confirmation, okay? We see some supply come in here on bar 1. This is 5-minute. And we see, we don't really rally. More supply coming in. This is now the U.S. Open, all right? So this is the first 9:35 bar, 9:40 bar is bar 3. Notice we get sustained volume and we're not going anywhere. And then on bar 4, we try to go down, we try to go up, and then we close in the middle. Or we try to go up, try to go down, and close in the middle. It doesn't matter. It's on a little bit less volume. What I notice here is that we get on bar 2 a really strong bar down on big volume. How come we're not making more bars? How come we don't have another bar 2 after bar 3, after bar 3? How come we don't have, why isn't bar 4 like this, right, closing on its lows? Instead, it's doing something different. It's not making any progress down. The thrust from here to here was strong. The thrust from here to here is small. The thrust from here to here is small. From where we close down to the low is small. This is called shortening of the thrust. Okay, it's one of the common indicators. And it's coming in on high volume. So there's a pressure to go down, but somebody's in there buying it and keeping it. That's what causes this shortening of the thrust. Also notice 15 minutes of high volume activity, and we're going nowhere. We have clustering of closes. All the closes are closing in the same basic spot, right? We also notice as we're coming down, volume is drying up, and as I said, we're not able to move even on. That's no supply here, and that's occurring at support. We can draw this line from yesterday's high over here across, and we're coming back to test yesterday's high. Okay, that's what makes this trade a really good trade. Not so much that all of the intraday stuff is happening here, but we're coming into the opening and we're actually testing yesterday's high. And so that's where we make our entry right there. Well, I'll show you where we make our entry. And look at this a little bit. Here's where we were on the hourly chart. Here's where we were on the 5-minute chart. And then, of course, what transpires. Remember, our target is first resistance on the higher time frame. What we're really trading here is the higher time, this higher time frame, but we're doing it off of the smaller time frame, right? So our exit is going to be somewhere around 2670, and our entry, first entry would be really on any of these 2 bars, but I like the third bar here is the last cluster of closed bar is really good. So is the next bar. There you're seeing demand coming in, buying coming in. Then we get a little weakness here. We know that because the market went up and then closes on the low. You get a little bit of volume on that. Not too much, but a little bit. So what happens? The next bar goes underneath the low of this bar right here. rallies up and closes firm. It says that that weakness isn't significant. Don't worry about it, Mr. or Mrs. Trader. And so there again is another spot to either go long or now to add on to your position. Stops would be right underneath, and they're going to be dependent. Stops are going to be dependent on your account size and your experience and all of that. My recommendation, 1.5 to 2% risk on any given trade. 1.5 to 2% of your account risk on any given trade. So your first buy here would be somewhere in here. If you wanted to put the other contract on, you could in here. As this occurs and we break this, you can bring your stop up and slowly move it and so on and so forth. But that's that trade setup. So you get that idea there. Do your hourly bars start at 9:30 or not? Yeah, 9:30 with the exchange. Do you use a 200655 no, never on a round number. Never on a round number, 2655. That's not what you want to do. You want to put it on an odd number. So it would be down in here somewhere. You know, on an intraday, an average day, 3 to 4 points in the S&P stop is a good one. When it's more volatile, you need 5, 6 points, or sometimes a little bit more. What time frame combo do you recommend for swing trading? I'll give you recommendations at the end, but you'd look for your hourly bar would be a weekly bar, and your 5-minute would be a daily bar under swing. Okay. So now here's another example. Here we have non-trending day, but just to show you how this would work. We get that first big bar, the first good strong bar on the hourly here, and I've labeled that A to B, so you get a sense that this is the range of that bar. And what we're looking for, we let that close, and what we're looking for is to trade this area in here. So A starts up here, and B ends down here, and this is that area, you see. This is the area. We get momentum on the hourly, and we look for the weak pullback on the 5-minute. This is a hidden up thrust. I'll explain this in a minute, a little bit more, and then this is your entry right there. The market pops up and then closes down here, and we've got low volume, so it's no demand. That's a fine spot to enter on the close. I don't fool around with trying to get the highest tick or the lowest tick. Sometimes I will, what I call feather in. I'll put for example, if I thought the market might come up a little bit higher, I might put an offer to sell up here. But you know, that doesn't always get filled. So I don't play around too much with that. I will go in in the last minute or so, last 30 seconds of the bar, or right on the close, or even or just at the close. And we get another opportunity to go short here, where we bump our head up. Again, we come down, the volume comes up. We go up, the volume goes down. That's what we're always looking for if we're trading short. And so we would just, when we see that, we know that resistance is strong. So anywhere up in here, either on, you know, this bar is fine, the close of this bar, or anywhere in between in here. And again, your stop is going to be a few points up above here. And again, not on a round number. So don't stick it at 35, stick it at, I don't know, 35 1/4, 35 3/4, something like that. What basis are we considering going short on this hourly chart? This strong hourly bar right here. That's the basis that you're considering going short, because that has moved the market down to this point here. And we see volume picking up on the downside as we come down. We talked about how more downside is to come. And so we're looking to capitalize on that, and we turn to the 5-minute for a weak pullback and entry. That's that trade setup. Okay. Is that the only one I had in here? No, okay, I did two. That's good. Okay. So now let's talk a little bit about signs of weakness and signs of strength. I'm sorry, signs of weakness. No demand and upthrust. We'll talk about that. So no demand. It's a narrow range bar that closes above the last close of the prior bar. Okay, so in other words, if you have a bar that closes here, and then you're looking for a bar that closes above. This is higher. This is the bar 1 and bar 2. We're concerned about bar 2's close, and bar 2's close is higher than bar 1's close. That's what we're looking for. We're looking for narrow range, not that wide spread that we see on those hourly bars. We're looking now for just the opposite of that, and not the volume that we saw. We're looking for low volume. And again, we tend to like to use the volume less than the previous two bars, but again, it's not rigid, right? No demand to be effective has to be in the right place. We see no demand all the time on all the charts, but that doesn't mean that it's a good no demand. We want them where there's other weakness. We're always combining them with other signs of weakness, okay? So there must be weakness in the background. And in the way I like to trade, and what I'm going to suggest to you here, and that the higher time frame supports that weakness. We'll see how that all unfolds. Strength is added if the narrow range bar, the no demand bar, is an inside bar, inside the previous bar. That's really important. So in other words, you get a bar like this that closes here, and now your no demand is an up bar, but it's inside the high and the low of the prior bar. This is what we call an inside bar, okay? And so we often use this as an entry. Upthrust, I'll just go through this. Sometimes we call these a bolt trap. It's the reverse of the spring. It's a failure to follow through to the upside after we've broken above the last swing high. And volume on an upthrust can either be high, which means that supply, selling is coming in, or it can be light, meaning that there's no demand up here. Buyers are not following prices at these highs. I'll show you an upthrust, but what we're really going to focus on is hidden upthrusts. And these are difficult to see because the upthrust occurs on a lower time frame and therefore hidden from view. I'll explain that as we go along. They're really, really useful, okay? But setup says that volume should not be abruptly high as compared to the previous two bars. That's correct. That's correct. You will make an exception for the open, okay, the US Open, because there's always high volume there. Always, I shouldn't say always high volume. There is that, but there's always sudden high volume. So, okay, let's keep going. Now, let me give you a little bit of context here. We're on a 5-minute chart, but this line here says that there's a multi-day high right along here. I think it was 2 or 3 days back. This was recent. And so also I have regular volume up above, and I have what's called the Weiss wave down below. For those not familiar with the Weiss wave, it measures or calculates the volume on the swing. So we have a swing from here to here. That's this volume. We swing up to this point, here to here. That's this volume. We come down for a bar or two. That's here. We go back up, and that's this volume. So you get the idea. This is known as the Weiss wave. Very effective tool in trading this method. It's the only indicator we use is to aggregate the volume. And so I see that we go along up in here and we've got demand coming in, but this bar suggests that there was some, because it's high volume, suggests that sudden high volume suggests that there was some selling coming in. And the market goes a little bit higher and then rolls over. And I notice on this wave down, it's bigger than these other waves here that we see. Even this, it's much larger. And the downside volume is much larger. Now, you don't pick that up on normal volume. This is one of the problems with intraday volume, but the Weiss wave picks it up nicely. So this is in itself an indication of weakness. Remember I said in the very beginning that the common signs, one of the common signs will be the largest bar or the largest swing or wave opposite to the trend. So the trend's going up. This is opposite to the trend. This is the largest wave down on the largest volume that we've seen, at least so far on this chart. So it suggests supply is coming in. It's an important signal for us, or an important indicator for us. All right. Then as we go up, what do I notice? No matter which way you look, the volume's coming down. Right? We come up to bar 2. We get that little pop in volume, and look at the close. Well, that's weakness. We try to go up into here, and we know there's resistance on this multi-day high, and it closes back underneath. That's what we call an upthrust. Remember I said before, market makes a high, then it comes down, makes a swing low, and then it rallies, goes up, penetrates it a little bit, but then can't penetrate it all the way. It'll come back down again. Okay, that's an upthrust. And so looking at the volume up here, we see high volume on the upthrust, suggesting supply. Next bar is down with volume continues. Then we come up on bar 3 and we have that volume less than the prior 2 bars. It's an inside bar. And in fact, all 3 of these bars are inside. So this is coiling up is what that's suggesting. So this is a classic no demand after an upthrust. Okay? So there's the spot to take the trade right there. And the market then falls. We see buying coming in here. And I also notice that on bar 4, I'm not really picking up a lot of volume to the downside. And I'm at some sort of support in here. So there's the exit for that trade. Market rallies up a little bit more. I see lots of no demand in here, just no volume whatsoever. Okay, we rally up, we come up a little bit. We don't have, like we have here, the swings, right? But maybe on the smaller time frame, this is what is this, 5 minutes. So if we went down to some tick chart, we might see a swing down and then a swing back up, failure to follow through, and then a push down. Okay, it's a very useful skill to develop if you can see smaller time frames in the current time frame or larger time frames in the current time frame, the hourly chart in this 5-minute chart. Very good skill. So this is a hidden upthrust, and this is a trade. We take this on the close or take it as it's going down. I'll show you different ways of entering in a little bit on pullbacks like this. Several different ways that you can choose from. But really what's driving this is the no demand in here. And notice that the no demand is coming back into supply here. Here's where we saw supply come in. Now we're coming back up. We get no demand and a hidden upthrust. That's a Wyckoff story after an upthrust at a multi-day high, which is also part of the story, and it suggests more downside to come. And we get another hidden upthrust in here. Again, you can do the little trick of the smaller time frame here. You'd have to go down to a tick chart or a 1-minute chart to see it, which I wouldn't advise trying to trade off of. Okay, we got a couple of questions. What's the Weiss wave setting? It's on the S&Ps, it's 0.075 for reversals, 3/4 of a point for reversals. Is change of behavior same as sign of weakness? No, but it is the same as this large down bar. Okay. This large down wave, excuse me, with the high volume. That is a change of behavior. We're going up with light volume on the pullback here, and then suddenly we get large volume. SOT is shortening of the thrust. I'm not sure what the question is in relationship to, but SOT would mean short. Oh, I see. I've got it on this chart. Hang on, I'll explain. So you can see that, I just do it by the waves here. You got a wave up to this point. And we started, say, we broke out from here. So this is the amount of progress that we've made on this wave up. Then we pull back. And now we go up again, but then we pull back. So this is the progress we've made on this wave. You see? The thrust of the wave is shortening. Okay, you see that? That is done only by two things. Either supply is coming in and stepping on the market, or demand is not strong enough to push it higher. So it's either done by supply or no demand. But that's shortening of the thrust. And that's in the waves. We also have shortening of the thrust here. You can see that, for example, between the high here and the high here, we made good progress, right? But here, we don't make such good progress. That's shortening of the thrust. You can see it you can see it here too. We make progress here and then here, shortening of the thrust, okay? Common to both. We'll see it on the upside and the downside. Change of behavior is a sign of weakness. Yes. I'm sorry. I must have misunderstood your question. It is a sign of weakness. Why would not take the trade at 5? At 5. You could. I'm just showing you, you certainly could at 5. You can certainly take it there. I'm showing you a hidden up thrust though. I'm trying to explain a concept rather than all the different places that you can take a trade. I'm trying to explain a given sign of weakness and an indication for that. If you short the no demand, you're shorting into supply after a daily high was rejected. That's fine. This makes it, the hidden up thrust makes it stronger in this situation. How would you have not known to look for a long after the bar at 0.1? Because of the shortening of the thrust. And because of the high volume coming down. This high volume coming down tells me I don't want to be long anymore. I want to look now for shorts because this is weakness coming in. Okay. The wave following wave 5 is less than at bar 1. Okay. I'm not sure what the significance is of that. Would I consider covering at 5? No. I'm sorry, Steve, I'm not catching your question here. We are going short at 5. We're not covering, we're not long anywhere on this chart. There's no longs here. There's no longs. This is a short here, this is a short here, and this is a short in here. These are hidden up thrusts and up thrusts. I'm trying to give you a sense of what this is here. So there's no long trades there at all. The down wave is shortening. Yeah, so that's weakness. Oh, the down wave here is shortening. Yeah, it is a little bit, but it's still weak. I still have more volume coming to the downside and then no volume coming up. So my basic fundamental volume in the direction of trend or where it's moving and no volume when we're counteracting that is holding up here. Okay, that's the basic fundamental way of looking at the markets through this method. You should always go back to that. Always. Don't ever forget it. Okay, let's talk about how we can enter on these low volume pullbacks. Let's see where we are here. I think this is, hang on a sec. No, this is a different chart. Okay, so we're in a down move here. Okay, we see the volume picking up to the downside as we move down. That's good. As we try to rally, the volume dries up. We come back down again, and the volume picks up. All this is good. Okay, so we stopped the market in here, and this was support. Okay, when we come back to that area, which is why I have the red line in here, support generally becomes resistance. Why? Because, believe it or not, a lot of people were buying in here thinking the market was going to go up. They've held on with their long positions. The market's come down. Now, as it comes back up to here, they're thanking their lucky stars they can get out at break even. And that puts pressure on the market at this point. Okay? These are overly aggressive traders who are in a poor position that create this for us. And we want to take advantage of it. We also see supply coming in here. Okay, you see the story I'm building? I got downside, I got no upside, I've got more downside. Now we're coming back into where I've got good downside, and I've got what was old support should now be resistance. So now what I'm looking for is light volume, and I see that coming in. Oh, very nice. Let's take a look at these bars one by one. The first bar is probably hard to say because we have a little bit, but we have a little bit of no demand on this bar coming in, although it's not a good no demand bar because it is, hang on a second. Okay, it's not really a good no demand bar because it's a little bit outside the prior bar. It goes underneath, fails to go down, and then rallies up and closes firm. So that's not a really good no demand because it's showing some demand here by not continuing to follow through to the downside. So some demand is present, but not a lot. Okay. Second bar is either what we call a minor buying climax here, because we see that pop in volume, or a little bit of effort to go up, but the volume is stepping on that. Sellers are coming in, so there's no real result to go up. Okay, next bar, no demand. There is a trade. Third bar, and the start of the hidden up thrust. The third bar we see closes poorly, breaks the uptrend line, and we see volume pick up. So that's supply. Same thing on bar 4. We go back up to test again. If you hadn't gotten in before and you still want to get into this trade, there's another good spot to get in. So those are ways to enter the market. Okay, so let me give you a couple. That's just and a description about what's going on. So now we can enter on the close of the minor buying climax. That's bar number 1 up there, right? That's here. We can enter no demand on resistance. That's bar number 2. And we're entering on the close of these, or close to the close of these. You can close on the actual up thrust, or the hidden up thrust, technically, and that's bar number 3. You can short on the rally back up to 2030 on bar number 4, as I described, right up in here. You can also do other things. You can sell stop the low of bar number 1. You see that minor climax coming in with the big volume, and it doesn't go up. You know, if all that volume, if that volume was buying, we should see a bar that looks something like this, right? Big strong bar up because we get a lot of volume coming in, but we don't see that. Okay, so you can put a sell stop a tick or 2 below the low here to pull yourself in. You can, that would be 2 bars back. You can sell stop 1 bar back if you want. Either of these test out well. So you can sell stop 1 bar back or 2 bar backs, 2 bars back. Let the market pull you into the trade. And alternatively, you can sell stop a tick below the the trend line, or you can take it on the close after the trend line breaks, but you're looking for a trend line break, okay, basic trend line break. Any or all of these work out well. I would suggest you, if you don't have your own entry procedure, then these are the classic ways. They, as I say, they all test out well. Try them, pick one or two at the most, and use those. Stick with those. Yeah, so if the down raise, yeah, so you, Steve, yes, you would look to exit if it's shortening. That's correct. When you broke a major support, do you always wait for a pullback? No, not always. Not always. It depends on the it always is going to depend on the context of what you're working with. All right. So take a look at another upthrust. This is a weekly upthrust. Again, we make the swing high, the swing low, fail to follow through to the upside, and then start coming down. Okay. So this is a weekly chart. Let's take a look at the monthly, the higher time frame. Now I'm starting to move into what I almost always do for every trade. And I will encourage you to do so as well. Consult the higher time frame, HTF, higher time frame. In this case, it's the monthly. Okay. If we were working off of the daily, we would look at the weekly. If we're looking off at the 5-minute, we'd look at the hourly. If we're looking at the hourly, we'd look at the daily. If we're looking at the monthly, we'd look at the yearly. If we're looking at the yearly, if we're looking at the quarterly, we'd look at the weekly, and so on. Okay. All right. So first thing I notice, back into the area of supply to the left. That's the first part of our story on the monthly chart. Okay. We are at the top of the trend channel. So we are overbought in the trend channel. That's number 2. Okay. Now I look at individual price bars. Large volume jumps out at me. And what I see, price is down. It's a down bar. Selling has come in here. Not surprising because we're back in the area of selling and we are overbought. But the market will still rise. I notice that the volume is relatively light, comparatively light, but we went underneath that prior bar, rallied and closed above. So that's some strength coming into the market. No question about that. So let's see if it will continue to penetrate this supply, is what we would be saying to ourselves. Bar number 2 comes down, okay? Right after what should be strength, we're starting to see weakness coming in. The next bar, fairly light volume. This would be a key reversal underneath the prior month's low. We'll talk about that in a minute, but on low volume, this is testing in here. So it suggests the market's going to rally back up. Okay, that's good. We're on a monthly chart. I mean, this is very valuable information. If you are trading anything like the swing or even intraday, it's going to tell you where the weekly is likely to go this week and how it's likely to get there, and then you can figure out your own, intraday trading off of the daily charts. Bar 3 now goes up, and we see that it's not quite less than the previous 2 bars in terms of volume, but it's light volume. This is where the rigidity, we let go of the rigidity, because this is saying no supply, even though it's not really inside the prior bar and it's not volume less than the prior 2. It's saying that there's not much supply, but that speaks to us because of what's going on and where we are in this monthly chart. If we looked for a no demand, I don't know, this volume looks like it might be just less than the previous 2 here, or maybe we can find another up bar. But let's say we were looking at that, and then the market moves up. That's not no supply because we don't have any weakness in here. It's no supply technically maybe, but there's no context for it. So we ignore it. We just throw it out, okay? So this is where we are coming into this upthrust on the weekly, and we see the weekly have the upthrust. We haven't done anything yet. It's already made this bar, and it's starting to work on this bar. We haven't done anything yet. We have to go now to the daily chart to both confirm what we're seeing on the weekly and to look for an opportunity to get short. This is the method of multiple time frames. So here's what we're looking for is a short that actually occurs in here. This is misplaced. This is incorrect. It actually occurs in here. Notice we get that first large volume down. This is the 65 trade setup on a weekly daily, okay? So that weekly, we've got 2 weeks in here really. And this is now for, I forget, Tom, your question now about are we missing out by not getting it in at the tippity top? Here you go. We wait for this, and now on the daily, what we see are no demand, or I'm sorry, hidden upthrust on bar number 1. Let me erase this so you can see it a little bit clearer. We pop up and then close underneath this line in here. So hidden upthrust followed by no demand. Either of these bars is fine to short on, okay? Market comes down, you got another no demand here. You could add to it on that bar if you wanted to. Market comes down, we probably have a little bit of no demands in here as well. Keeps coming down, pushes down hard, big volume. Is the volume, okay, are we now gonna buy? Should we be buying this? No, because there's no demand in here and then hidden upthrust and another opportunity to go short, okay? That's how we trade this. So we go to the monthly to confirm that there's supply coming in on the weekly. We see the weekly upthrust, which is a sign of weakness in its own right. And then we look for confirmation on the daily in terms of lighter volume, narrower spreads, the no demands, the hidden upthrusts. No demands, the no demands and hidden upthrusts. And that's how we make these plays, okay? Yeah, Steve, if I say tests and I mean no, and it's no demand, or if I say no supply and I just reverse it, I get, my mind's working a little quicker than my mouth sometimes, or vice versa. Please explain how monthly bar 3 is no supply. So it's no supply because it's low volume. Okay, we're going up on low volume after all of this weakness. That's why there's no, I'm sorry, no demand. There's no demand, not no supply. If I said no supply, I apologize. I meant no demand. I'll go back into the video and correct it. Do you judge supply by the range of the bars or the volume, or both? Both, always both. And also the waves. Can you only use large range of the bar to judge supply even if volume is low? No, you use all the bars. You want to put together a story, okay? You want to put together a story. So yeah, Tom, that's the point I'm trying to make. Don't get caught into tickitis, getting the last tick, or selling the highest tick, or buying the lowest tick, or whatever. Try not to get into that. Get in what you want to get into, where you want to put your energy into, is exactly what I'm showing you. Being able to read the market and knowing when it's right to take the trade. Okay, so let's talk a little bit about signs of strength, tests, no supply, and key reversals. Okay, tests and no supply are really the reverse of the no demand bars. We're going to see narrow range closes now are going to be on the low side, not above the last close. Volume is going to be very low. Again, it's relative to the last few bars. Again, it's got to be in the right place. We've got to see higher time frames supporting this. and there's got to be strength in the immediate background. So it's both the immediate background. This is when I refer to background, what I'm talking about is the immediate background, what you see on the chart of interest, okay? And then also look at and it has to include the higher time frame supporting this. We're always combining it with other signs of strength. Inside bar is the same, and we use it as an entry. Key reversals are like the opposite of the hidden upthrust. It's a failure to follow through to the downside after breaking below the recent lows. It comes back up above those lows and closes on its high. That's why we call it a reversal bar. It goes down, reverses, closes firm. The volume can be high, demand's coming in, or light, no selling. And we use that as an entry as well. Let's just take a quick look at key reversals here. Again, it's coming under and closing firm, okay? Coming under, closing firm. This is a very nice key reversal. It's actually setting up a little bit of a spring where we see the shortening of the thrust. We're coming under these bars and reversing back up, but we're also coming under this swing low, rally up, come back, and we do actually penetrate. I'm sorry, this is kind of canted a little bit down, and I couldn't get it to be straight. I don't know why, but I just couldn't, and I gave up. So that should be a little bit higher up, and you can see that it penetrated a little bit. So we push up. Now notice this, these are not key reversals, okay? We're not going underneath anything here on these bars. Here we are, but it's not underneath of a down move. It's underneath weakness. So this is strength in its own right. This is quite a strong bar here, because there's some weakness that comes in, a little bit of selling comes in, and we go underneath of it, immediately reverse, and then come back up. I mean, trading this, I would be looking, if I were, you'd go drop down. This is a weekly chart, so you drop down to the daily to look for opportunities to enter if you see this coming. But this is a strong sense, it's strength coming in. Are tests and no supply synonymous? Pretty close to no supply. Pretty close to synonymous, yeah. Does the volume have an effect on the key reversal? Well, as I said in the prior chart, volume can be either high or low. Doesn't really matter on key reversals. And this, okay. Sometimes you'll see Tom Williams talk about them as tests on high volume tests. That's what he's talking about, or that's what he did talk about. Let's talk a little bit about no supply. All right. So, we use that light volume, low volume, less than the previous two. It's a good little rule of thumb. So the first one is actually not. This is a mistake in the chart, and I left it there on purpose because it's an educational moment. I was just looking at the volume, and I wasn't. I was actually more interested in some of this stuff over here than I was over here, and I just said that as no supply. So yeah, it's got the volume less than the prior two. It's not, technically it's not a classic no supply because the range is pretty large, right? What we're looking for is a narrow range compared to all of the bars before. So we get this narrow range. But that's really what we want to see, is something like that down in here, and a bar that closes lower on light volume. But that's not what happens. It's wide. So that's actually it. There's no selling there on that bar, but in terms of an actual no supply bar, not the greatest. All right. The next one is pretty nice. That's a narrow range bar, closes on its lows, volume less than the prior two. It's an inside bar, and so on and so forth. Okay. The bars that I marked with a 1 here are key reversals. Right? There are various volumes with these. A lot of times you see the buying. Here we have a shakeout where the market comes down and then we push down hard. Right? Volume comes in and we immediately reverse. So it tells us that that weakness isn't really weakness. There's strength there. And if we think about this, this is a very nice trade because we're coming right back into down in here where presumably there was a little accumulation going on. So it's dipping back down to either accumulate more or or I should say, most likely it's or, to test out, make sure there's no more supply down in that level. Because there was a bit of a fight. You can see there was high volume. We spent a fair amount of time down in this area without moving out of it. And so there's some buying that went on, and that's what's happening here, testing. They didn't draw a line over here. Well, let's talk about the no supply first. So we've got no supply coming in here. Volume is low. Notice that this volume is a little higher than the prior two bars, slightly higher. I discount that. I say that's no supply, because if there was real selling, it would push down. And then what we get here, so that's what I mean by being not rigid. If it's close, it's good. That's good enough for our work here. We don't have to be absolutely precise. We're not doing rocket science. Here, a nice key reversal, because we rally up a little bit, the volume expands. As we come down, the volume contracts, then we get the key reversal saying all is well. What it's really doing is checking out this shakeout in here. And then we rally up from there. We get a little supply coming in on this bar. I didn't highlight that, but basically, even though some of these are not less than the prior two, this is all no supply. Narrow range bars, selling is not having an effect on the market. We get a key reversal. Again, this looks cockeyed to me. We get a key reversal, a little more no, I don't see it. We get the lifting of the lows, the market rises up, another key reversal. Now look at what happens here. We get our first down bar on, so I can't tell where the volume is on that. Probably not that bar. We get a key reversal, and then it's followed by a negative bar. So we might have bought this thinking we're going to continue to go up. If we see this, it's time to exit. Okay, so we get out of this at break even, and we make a decision as to whether we would consult higher time frame as to whether or not we want to exit out everything here. And then more no supply and key reversals come in. Okay, do you think higher volume inside bar after a key reversal has an effect? Salim, I wouldn't know. I'd have to see the context. I'd have to see what you're talking about in terms of the chart. You really have to see exactly what we're looking at to be talking about, that's on too much of a conceptual level to be able to answer. What's the difference between no supply and a no demand bar? Well, one is showing that there's no selling, and the other is showing that there's no buying. No supply means no selling. No demand means no buying. No supply often is accompanied by a period of consolidation. Well, that's where you're going to see it a lot. Yes, you're going to see it a lot in there. So we'll just do some more tests here. This is on the intraday. I'm not going to spend a lot of time on this because time is starting to run here. We've got a lot of slides to get through still. These tests are down bars. Nice none of these are real. This is probably the best. If I could find a good test, this is probably the best test on the whole chart. Okay, narrow range inside the prior bar, comes down a little bit, closes in the middle, very light volume, just no supply. Okay, but you can see that when we get light volume compared to the prior few bars, and they're more or less inside, and we're not getting strong bars. These are less good tests because they're closing on the lows. As I say, this right here is the ideal test bar. But, everything else is close, and that's okay because we're not looking for perfection. Where can we get definitions of no demand and no supply buying climax? Well, there's not a no supply buying climax. And you'll have to go back up to the slides that I did earlier here where the definitions are. Okay, the definitions, the narrow price range, close below the last close, and so on. Okay. And you can tell that I'm basically throwing no supply and tests kind of together here. I don't make a lot of distinction between the two. Tom Williams made tremendous distinctions. He would have, I think he came up with like, I don't know, 20 to 30 different variations of tests and no supply. And I asked him one time, I said, why? And he said, well, it's like leaves on a tree, you can tell the leaf is a leaf, but they're all different. And so we want to know what those differences are. I never could figure out why we wanted to know all those differences, because they basically do the same job, whether it's number 1 or number 33 test. It's still doing the same thing, whether it's number 1 supply or no supply, or number 33 no supply. So I kind of just lump them all together, and I don't find that to be problematic. I really don't. Tom was looking for specificity in a computer program. All we're doing here is looking to see, is there selling coming in or not? Okay. So for test bars, do they have to close at the low, middle, or the high relative to the previous? Well, they have to close below the prior bar's close, and great if they can close in the middle. So this is the ideal test bar right there, as we said. But they can close on the low, or they can close on the high if they're still below the close of the prior bar. All right, I want to move into now buying climax, because we're going to be talking more about no demand and no supply and tests and all of that as we go along. Okay, so for a buying climax, we want to have an uptrend for a major signal of weakness. And the more mature that trend is, the better. Okay, so we want to see the trend go along for a long time. And price typically will reach beyond the trend channel into overbought conditions. Right? That's for a major signal. We can also have it as a minor signal. We frequently see it on minor pullbacks in a trend. And as I showed you earlier, it's often a good entry on the intraday and also on the swing. You get that large volume and price goes nowhere or closes poorly. The stride, or the angle of ascent, will also steepen if it's a major buying climax. Now, that's the general conditions. Then we look for the specific conditions. The price range and the volume will both expand dramatically. And volume is going to reach those abnormal levels. That's what happens in a buying climax. There's lots of buying is present. The public is rushing into the market. Wyckoff used to call it demand of poor quality. And selling will be superior. And we see this in the poor closes on the high volume. And that is the larger players coming into the market, the institutions, the large players coming in, seeing price at an opportune moment and stepping into the market and selling it. And when they sell, they're going to be superior because they have the ability to temporarily move the market or affect the market. So the close is going to be poor, mid-range or lower, and it can certainly occur over 2 or 3 bars. And the volume can occur over 2 or 3 bars, and the volume can occur before, well, the climax will be reached, but the market can continue. You'll see this in a minute. The market can continue a little bit further in the direction of the trend before stopping. And as I say, it can continue a little higher, but it's going to do that on things that we are learning about here and starting to become familiar. It's going to do that on no demand and poor closes and should be hidden up thrusts, not up thrusts. What's a poor close? A poor close is off the highs. It's in the middle or lower. How far back? Number of bars. We're not doing computer modeling here. So this is a discretionary method. So it's over the last several bars. You can decide what that is. And I would suggest that you become, if you want to trade this method, you want to become good at this method, then start becoming familiar with it. What I'm telling you here is all true to the best of my knowledge about it. But you need to also confirm this for yourselves and see what it is that I'm talking about. So you might have to review this a few times and then work with your charts and try to see it in here. And if you don't get it, then drop me a line, and I'll try to give you a sense of that. I try to help you out. Okay, drop me an email with a chart. Okay, so here's an example of a buying climax. We're looking at a daily chart. This is IBM. It's a stock. So we're coming down, and we break the downtrend channel. Volume and range expand on the rally. Right, we know that's good, and then contracts on the reaction. We know that's good as well, okay? But then things start to change. We push up here on very high volume, and we don't go very far. And we close off of the highs, but we don't go very far. This is a lot of effort to move the market up, but somebody's stepping in and not allowing it to go up. So this is shortening of the, so this is, I'm sorry, effort to go up, but no result, effort versus result. Bar 2 shows even more supply coming in. By the way, effort to go up. So there's a lot of buying in here, right? But somebody is selling into it and keeping this from, you know, if we've got a largest volume here, think about it this way. This is the way to think about it. On this volume, we made this progress. On volume that is, okay, not a lot more, but the same amount, we made less than about a third of the progress. How come we didn't do all of the other third and close like this, just like we did here? Oh, I'm sorry, close like this, just like we did on this bar. We got about the same amount of volume, a little bit more. How come we didn't do that? There's only one reason, only one. Selling is coming into the market by superior forces. That's what's causing this to narrow range, the range to be narrow, okay? And then the second bar is a poor close, defined for you. It's closing on the lows. We also have clustering of closes for 2 whole days on all of this volume. We could add all this, and it's twice the volume we've seen on any other bar or any other couple of bars. And we made no progress. Clustering of closes. So effort versus result, poor close, and clustering of closes. We're building a Wyckoff story, okay? Have I heard about Lindell reversal bars? Nope, haven't, sorry. Can't comment on it. What about the gap at 1? Doesn't this count as a true range as we did in the gap up? Yeah, we can count it as a true range for so we can count it as a true range. Let me, the reference is that we often count this as a range, as we will draw the line down to see what it's done. So we did, but look at the amount of progress that we're making from the high here to here. That's what I'm talking about. There's no progress up. So even if we do that trick that we sometimes do to see where the market went on a given bar, it's still showing us that it's somebody stepping on the market. Okay, good. Okay, so, but we don't stop there. Just because we have this doesn't mean anything. The market could just as we saw on that key reversal, remember where we had that little bit of weakness and then the key reversal came in and actually closed above it. I said that's really not a key reversal, but it's a really strong bar. So the key reversal look-alike, I should say. This could have, you know, we could get short. This could have some strength and start to move up again. So I want more than this in my trades. So I'm going to look at the weekly chart. And here's IBM on the weekly. A lot of supply. Bar 1 closes off the high on very high volume. Selling coming into the market. Bar 2, same thing. Selling coming into the market. Bar 3 can't even make a new high. Makes a new low. Closes poor. Selling coming into the market. I forget what I wanted to say about bar 5. Oh, I guess yeah, so here we see that this is a down bar, narrow range inside, volume less than the previous two. It must be no supply. Okay, maybe temporarily, but this is a lot of supply coming in, so we're not going to view this as this is in the wrong spot, is what I want to point out here. We do rally up, we come right back down again, more supply. So we're coming back into this area, and look at what happens on the weekly chart. We get a poor close, a mid-range close on huge volume. So this is supply coming all over the place. We got a Wyckoff story. We got effort versus result, clustering closes, poor closes, into a weekly poor close, into big supply on the prior old top in the background. Okay, I'm pretty confident now that we got a good trade here. So now we look, we don't just go short. Now we've got the initial conditions. Now we want confirmation. We're going to get that on the lower time frame. So now I'm dropped down to a daily time frame, back down to the daily time frame, and I see a key reversal coming in at support. Okay, and that's going to try to push the market up, and it does. But when we get back up to the top here, what do we see? Again, no supply coming in here, right? Just no supply. The trade is on the close of bar 6. We see volume pick up to the downside on a poor close, and it's fine to short in here. Your stop is up above somewhere, 2.5 point, 3 point stop. And on a $200 stock, that's not bad. And then you're looking for a move down. Okay. No demand. I apologize. No demand. Yeah, I get those crossed all the time because I'm talking and I'm actually trying to look at the next thing. Okay, and I'll just, so if it sounds confusing, then I made a mistake and I apologize. Where's the entry? Yeah, close of bar 6. The close of bar 6. That's right, Robert. Okay, here's a weekly buying climax. We are from, a couple of years, this is almost current here, in a stock, a weekly stock on the 3M. We see supply start to come in. Is this climactic, the huge volume? Not quite, because the next reaction, we see lower volume coming in. So we go up to C, the volume expands again. We come down, volume drops off. Now we come up and look at here on E and F. For the first time on bar F, we get high volume on the down bar. Okay, that's the change of behavior right there. Until that point, we are continuing to go up. But I want to look at this, and I want to take a look. This is a quarterly chart now. Remember, we're working off of the weekly. Does this make sense on the quarterly? Well, we're overbought. This goes all the way back for this stock to the low at 2009. These are all quarterly bars, meaning there's 3 months in each bar. Okay, and look at where we are. And these are identical now, right here. So we have clustering of closes, a poor mid-range close, which is a poor close. It's overbought beyond the confines of the supply line in the trend channel. We're also getting shortening of the thrust right in here on these 2 bars. We made all this progress on this one. We make only that progress on this one. Okay, there's a good Wyckoff story brewing here for trading this stock to the short side. So how do we do it? All right. So looking at the daily chart, and this is the weekly over here, and this is the daily. And 237 brings us this, I think, or in here, yeah. at 3 is where this chart ends, right here. This chart ends right there. Okay, the weekly chart ends right here on the daily. So as we look at this, we already know about F being supply. Well, G is even more supply, right? And that's come in. And again, Tom, this one's for you. I kind of thought this one up as I was doing this, and we didn't get the tick up here. We're going to be down in here getting this trade. But let's see what happens. So we get the supply here. We see it we see clearly supply coming down at F. Yeah, this is F, and then this is G here. So this is F, and then this is G. Then we rally up, and we have a minor buying climax. How do we know? Because we get that sudden pop in volume, and then the market reverses the next bar. Okay, and it's coming into the supply. So, and it's overbought up here in the trend channel. You can take that as a trade. Okay, it comes down. We see volume pick up to the downside, but I get a strong key reversal here with a lot of volume, and the next bar is up. So I'd either exit the trade or we would hold it through this. But let's say we exit that in here. We rally back up. I see volume diminishing on the upside. We get a reversal up here, and then another negative bar in here. And there's your trade right there, selling, and it's coming right into the selling. We come down a little bit, volume picks up to the downside. I get another negative bar here. That can be entered on the close on this daily. We drop down to this level, a little bit lower, and then we come back up again. I notice on the way down to 4, volume picks up to the downside. As we push up, volume is receding. We get the hidden up thrust there right at the end of, well, this is beyond the end of this chart, so we short that. And I'll orient you in a second. Notice this, and notice this and this. I'll go back. Those are right here, and right here. So here, here, and here is the same as here, here, and here. So this is the last hidden up thrust, and we take this trade down. We can put in trend channels, see that the trend it's coming down here at the bottom end of the trend channel, and as we're coming down, what's happening to the volume after this? It's getting less in here, so we're going to exit in here. Okay, that's our exit. So, Tom, no ticketitis here, or tickitis. We don't need to get short up in here. This is a risky trade up in here. We don't know if it's going to play out or not. It's great if we do it. We look like heroes and it feels good and so on and so forth. I'm telling you, by this method, these are the best because we always have supply in the background. We always have supply on the higher time frame. And that's what's going to drive us down. Where is the best entry close? Okay, so we got it. All right. So another buying climax example. I remember this one. This one's a while ago in gold, where on a monthly basis, look at this. Okay, buying climax there. That was huge. All right. So we can do a little bit of reverse. We see this bar on the monthly, we can go to the weekly and say, oh, how did we get there? And how we get there, we're rallying up. Notice how we're in this trend here. Remember I said that climax is the angle of the stride, or the angle of the ascent will steepen. It gets parabolic when it goes to the upside, okay? And it's steepening here. That's a key criterion by which we can anticipate a climactic action to occur. And we start seeing the negativity coming in. Bar 1 here, this weekly bar 1, high volume, poor close. Bar 2 goes higher, but no demand comes in. Does this look familiar? I mean, this starts to be the same stuff over and over again. We come down on bar 3, increase in volume, poor close, although there was a little bit of buying at the bottom of that bar for the last day or two. So we rally up to 4. Look at what happens on bar 4. No demand up there. Fairly narrow range, inside bar. That's no demand. Did I get that right? Or is it no supply? I forget now. No, it's no demand. It's right. Okay. Now we come to bar 5. And you see that we're making a new monthly high up here in, I think it's October. That's this bar here. So the high of 5 is right here. So let's take a look now at the daily. So we rally up here. We see some supply coming in on these couple of bars, but it holds. Again, we always go back to this over, and we never forget this. Expand on the rally, contract on the reaction. Expand on the rally. Ooh, it's expanding on the reaction. That's no good. Sign of weakness. Do you see what I'm saying here? Expands on the rally, contracts on the reaction. Expands on the rally. Uh-oh, expands on the contraction. You see, change of behavior first, swing, bigger, and so you see the swing size is bigger than the last couple of swings. We don't really have a lot of swings in here, but the swings get bigger to the downside, and the volume comes in to the downside. We do rally up. That three. We hit that low in here. That's down at bar 3. We rally up on the no demand. Right? All the way up to here on no demand. You see the no demand. That's bar 4 to here. And then we get an up thrust after all that weakness. There's the trade. There we can take that trade without thinking twice, because this is a sign of weakness in its own right. We got a tremendous amount of weakness here, and if we go to the quarterly chart, we even have more weakness. Make sense? Why is bar 2 no demand? Bar 2, where's bar 2? Because of the light volume going up. Why are we, let me ask it this way. Robert, think about it this way. On bar 1, we get a lot of volume coming in. We go that far. All right. On bar 2, we actually go higher. Why don't we have more volume if we go higher? Wouldn't we have more volume? Wouldn't it require volume to push the market up if we're going higher? Well, if we don't have volume, then that signifies no demand. It's not suggesting that you take the trade right here, that you say, okay, bar number 2 is no demand, so I'm going to go short because we have some selling over here. That's not what I'm suggesting at all. What I'm looking at is I'm building a story of supply coming into the market. That takes a little bit of time. But I'm building that Wyckoff story of supply that has occurred over a long period of time, and therefore we're going to get a pretty good move out of it. The target on this initial one was the bottom of this trend channel, and that's where it went here. But look at that move. That's a huge move in this market. Almost 400 points. That's big. That would have made anybody's, one contract would have made your decade, I think, on that trade. Let's see. If the change of behavior wave coming down, but without the heavy volume, does it still? I don't know. We'd have to see the context. We'd have to see the context, Alan. I don't know the answer to it. If it's large like this, and what kind of volume are you talking about? Light like this, I'd be very suspect of it. If it's average volume, I'd be thinking it's supply. But you're trying to get me to answer a hypothetical question that I can't answer. So you have to see the context. If you got a question like that, a chart, send it to me and I'll be happy to answer. But you are calling it no demand because its relationship to the previous bar only. No, I'm calling it no demand because of the relationship of the volume here. Yeah, to this very high volume. Yes, that's correct. In this case, I am. This is, again, I'm not being rigid. I don't have to have volume less than the prior two. It's close enough for me to be able to see this as suspect, as not believing the volume, the chart, if you will, not believing. Why? Can you guys hear the sound now and see the screen? Yeah, okay. I apologize for that. Something happened in the internet. I'm not sure. The screen went blank and then it came back on and then everything was gone. All right, it's okay now. All right, so Robert, you're trying, you said, okay, it's only the last bar, not the last several bars. What I said before is really important, and this comes with experience. If you try to be too rigid with this and say, oh, I can only, and I would suggest you start rigidly to begin with, so that you get a feel for this method if you don't have a good feel for it. But as time goes on, you begin to realize that, when we talk about support and resistance, it's not a particular price point, it's an area. And when we talk about no demand and no supply, it's not always volume less than the prior two bars. It can be a little different than that. Okay, but this is no demand. It's clear no demand coming in here. All right. Let's see. So that's weekly and monthly, and then the daily. So this gives you a nice trade in here on this, or it did give you a nice trade in here. Selling climaxes, as I said, are the reverse of buying climaxes. So we don't have to spend a lot of time going through definitions there. But I just want to remind you that we have the normal angle. Typically, if you were to, most trends, good trends, this is a little bit, this is a little weak to start with, but most trends are on that 45-degree angle. That's a really good trend, either up or down. But you can see here it's not quite on that, and then it plummets. So if it was on a 45-degree angle, it still will plummet, okay, for a selling climax. That's the first thing you want to look for. As soon as you see this plummeting action, large volume, wide spreads, you start thinking about climactic action, selling climax. And this is the selling climax that occurred in over 2008 and into 2009. And so you can see that it takes some time before it all unveiled. We dropped down a little bit lower, still had high volume, dropped down even lower, and then we get a bottom reversal, which we're going to talk about in a little bit. But on the way down, the volume is still declining. And as we look at this on the quarterly chart into that April, or into this area here, we see on the quarterly that buying came in 28 in the last quarter, in here and in here, and that then we came down and we have buying coming in here as well, and we're closing back up above the prior quarter's low, which is a bullish. When we look to the yearly, we go back and we see we are in yearly support, which we were, and this created a yearly spring in 2009. And that's why this market has driven all the way up until 2018, where we have the first down bar on a yearly basis. Okay, but that's our climax in 2008 and 2009. Okay. So selling climax on the 60-minute. Here we've got that angle coming down, that normal angle of descent. It's not a strong move down, but eventually this is how we tell that it gets into a climax. We plummet down. This one plummets. We get the high volume coming in. This is also known as a bottom reversal. This is on the S&Ps on a 60-minute chart. You can see the shortening of the thrust. You can see the buying. You can see the lighter volume as we're coming down, a little bit lighter. And then we dip underneath these two bars and boom, that's strength coming in. That's climactic action there. And we're way outside of the trend channel on that 60-minute basis. So does this make any sense for us? Well, yeah, it does when we start looking at the higher time frames, because we can go back to yesterday and see that we're coming right into yesterday's low. Now, this is a 15-minute chart. So we have yesterday's low is in here. We have selling coming in, climactic action potentially coming in. We can shift now to the 15-minute chart before this bar 3 even really starts to fully unfold. We see again the shortening of the thrust. We see the closes are poor. This close is coming up. Volume is dropping off, and then this is a nice. Is it key reversal? I didn't see. Not quite a key reversal, but you know, again, we're not going to be rigid about these things. So here's a buy opportunity right here on this buying climax. Okay, we don't have to. And here's another one, because as we're coming back into here, this is testing and we're not seeing supply coming in, and we get a key reversal here. Okay, so again, we don't have to get right in on the low. We don't want to get right in on the low. We want to confirm this stuff. Once it's confirmed, once we're confirmed, we know that the market's going to move. The direction now is up, and it's going to be up for a bit of time. Okay, we also have something called stopping volume. And this is basically the same as climactic action, but there's no trend. Okay, typically it's a straight down move. And I like these, especially on the intraday, looking for a straight down move into a daily high or low. We see that fairly often on the intraday. So we're looking for that straight down move. And of course, if we're in higher time frame support, which we're going to be if I take a trade in this, and I would encourage you to have if you're going to take a trade in this, that it exists. Okay. So again, here's stopping volume. Every one of these is stopping volume. Okay. And again, it's that high volume coming in. So we see stopping volume here on, this is a chart of Bank of America stock. We see stopping volume coming in, and we'll see this, the widespread bars, and then they'll close firm or give us an indication that buying is strongly coming in. And again, I'm not a big, you could buy this surely if you wanted to, because we get the low volume coming down, right, in here as it tests. It's testing in here, but really it's got to come back down. I prefer to see it come back down. We get a 2-bar bottom reversal, which we're going to talk about, and we see the volume is very low when we come back down compared to this volume, right, over here. And we get that bottom reversal, then we get a little bit of shakeout, and this bar here is also an opportunity to buy either of these 2 bars. Sorry, let me erase those. Either of these 2 bars here. But you'd want to be looking to buy this either as it's rallying, or this is pretty widespread here. So you can look the next day to, it's what I call feathering in. Typically, we will see that when you have widespread bars, the market will come in the next day or two, like it did here. Somewhere, generally, we look for a halfway point. Sometimes it goes a little higher, sometimes a little bit lower, but in general, that halfway point is where we look. So if you were looking on an hourly chart down in this area, you'd see the move start to turn to the upside, and you could buy it then on that if you're trading off of this daily chart. Oh, sorry, not Bank of America, it's Boeing. That's right. BAC is Bank of America, not Boeing. So, we were only looking on the daily chart, and notice that the stopping volume comes all the way down, and it makes this low here in November. Looking at the monthly chart, it makes that low. Notice I didn't make a suggestion that this get traded, and there's a reason for that, because this is the low here in that month. Now we come back, and I go underneath last month's low, setting up this. This is also a spring as well. So this makes, in December, this makes for a very good trade. And it almost, if you're holding monthly lows, then, your target is going to be going back up and seeing if you can't retest the high of the month. So honestly, it doesn't really make much difference where you get in down here. Anywhere down in here, if you're trading for this, is going to be fine. Make your trades where you've got that good Wyckoff story of support on the higher time frames, support on your lower time frame, and you can make a case for it on all the signs of strength that we have. What we're basically doing is adding in signs of strength until it becomes compelling for us to go ahead and take the trade. That's how we make a Wyckoff story. Here's a little bit of 5-minute stopping volume on the S&Ps. You get that here at A, and we come down a little bit more, and then we get the buying coming in at B, and then the market starts pushing up. So the real trade in here, if we were trading off of this time frame, I'm sorry, the context though is that we have a 2-day low in the background, so that first bar going up or this are both good entry opportunities. This is a lookalike of a test. And this is an overall test on a swing basis. Markets don't just test by bars. So swing down and then a swing up, and this swing is testing the supply on this swing down because of the high volume here on A. And if you notice, we're coming right back into the middle of A and looking to see, is there volume there? No, there isn't. And we're also testing out to see if there's any supply coming in. Maybe there was some supply on this volume here as it's going up. Testing for that and didn't find any, and then the next bar is good. So you would, again, you could buy on the break of the trend line, which there's no real trend line here, but you could buy stop this bar, you could buy stop 2 bars back, you can just go in on the close, you can be aggressive and buy the no supply lookalike down here as we get shortening of the thrust and narrow range. Okay, but that would be a more aggressive play. This is a much better play right here, much safer play. It's unlikely the market's going to turn right around and on that kind of volume and go back at you. It's possible, but not likely. Okay. Somebody asked about end of a rising market. I call it capping the market. It's based on effort versus result. We have a basic indication of an up. The basic indication here is an up bar on narrow range on abnormally high volume. And this a trend has been going on for a bit of time, okay? We would see additional strength if it's into new high ground, if we've never been there before. So the S&P is above whatever the high was, the recent one, 27 and change, 2,700 and change. A new high into 2,800. That's new high ground. Fresh new high ground would be a high into an area where for the last, say, 3 months or so, there was nothing on your chart to the left. Okay, so you're here. We haven't seen prices in here for the last 3 months. Okay, that's as far as our chart goes, and there's nothing here. So that would be considered new high ground for this market. Okay, so either into actual new high ground or 3 months. A gap up adds to the strength. Oh, I'm sorry. This should be under here. This should be indented and under here. It adds to strength if there's a gap on it. And this is one signal we don't have to coordinate the higher time frame. But reviewing the higher time frame is nevertheless recommended. It's always recommended. Okay. So here we go, capping the market. This is JP Morgan. We have a gap. We have very high volume. We got narrow range. This is a fairly rare, by the way, this is a fairly rare sign of weakness. It doesn't show up a lot. And Tom Williams used to say, you could short it right on that. That's not my cup of tea. I wouldn't do that. I never do that. So here we have, here we have the, sorry, I got a standing desk and I'm sitting down doing this and I just touched it and it started going up. That's what you might have heard the noise. So here we have the end of the rising market or capping the market on bar number 1. Bar number 2 shows supply. We've got volume coming into the downside, okay? And then bar number 3 shows a very nice, less than the prior 2 bars, narrow range, inside bar, closes on the high, but kind of mid-range, no demand, okay? Capping, some selling, no demand. So you would think maybe that's a good thing, let's go short on that, okay? Well, as I said, it's a good idea to check the higher time frame. And when we look at the higher time frame on this week, we're seeing good volume and the close is fairly firm. I wouldn't short that. There's no reason to, there's no weakness in here, okay? So let's let it go on for a couple of weeks, let it unfold and see what happens. So we let it go unfold and we see supply come in and more supply come in, and we try to rally up. There's not a lot of demand in here, supply again, and then we get the hidden up thrust off of actually this bar here. We're just doing it off of this, but you got 1, 2, 3 bars of weakness, inability to rally up despite hanging in here for a while and closing the so-called gap, whatever. It's still failing to rally. And now we see on the last bar here of the weekly, it's no demand. Up bar, not quite an inside bar, probably, but inside this is, we got 2 days here, 2 bars here of inside. So the market's really coiled. It's had time to get short, in other words, the larger players. So we're looking for a move, and the move on this would be down to here on the weekly or down to here on the daily. That would be the initial move. See if it goes any farther than that after it gets down there. Okay. Yeah, there's the target. And so here, I'm just showing the weekly. Here's where we were that last week of no demand. This is closed now at this point. And then bang, we come down and it makes the target. So that's an example of capping the market. Bag holding is the reverse. This we'll see more frequently than capping the market. I'm not sure why that is, but I see it a lot more frequently and I look for it. So this again is based on effort versus result. Now we're looking for a down bar on narrow range with abnormally high volume. Again, strength if into new low ground or fresh new low ground, again, a few months prior. We don't have to have a gap here, although that could probably add to it as well. And again, this is another signal we don't have to coordinate with the higher time frame, but it's a very good idea to do. So here, let's just take a quick look at bag holding on the daily. We see some supply come in. We see that pop in volume here, again, for selling coming in. But look at what happens. This is occurring over a couple of days. We have shortening of the thrust. We have clustering of closes. We have big effort to go down, especially on bar number 2, but no result to the downside. Look at all the amount of progress we made on bar number S here on all of that volume. Got the same amount of volume. We should make the same amount of progress. We should see a bar like this for bar number 2, but instead we don't. So somebody is stepping in, and it's always going to be the larger players. And we have a key reversal in here as well, going underneath the lows of those bars, right? So there's an entry. But when we look a little bit larger, we see that there was buying over in here. You can see that here and here and here. We try to go down and immediately reverse. And we've been coming up. So we're in some sort of an uptrend. We get a little wacky with some volatility. We come back into support. There's a story there. Okay. And if we look at this, here's the daily here. If we look at this on the larger time frame, we see some effort to go down here, especially on bar A. We see the shortening of the thrust. We see no real selling going on. And again, we're in a nice little uptrend. We might even be able to put a trend channel on there. But I'm not trying to show you trend channels because I'm trying to show you the price action. So we coordinate it with the higher time frame. We say, yeah, there's some supply there, but it's just not going down. It's not breaking. It's holding in here. Let's go long. And so there's opportunities there for you. Okay. Bag holding intraday. I say we see this a fair amount, and it's occurring in here. We get some supply coming down, a lot of supply here right off the opening, 9:30 in the morning on the S&Ps. This is the 5-minute chart. We come down, and it's not strong bag holding, but we see kind of a little pop in volume, and we see the markets dips down on each of these, but immediately reverses back up again. And bar number 3, we have really not a good no supply bar, but that is what I would view this as. Because why do I say it's not good? It's kind of a wide range bar, first of all. It went higher than the last bar, couldn't hold it, and came down. So some selling had to do that. Okay, and it closes poorly, which it's closing down, but now it closes poorly. The thing that I view, though, is the volume, and it's really low here. So I don't see this. I've got, 5, 10, 15, 20, 30, 35 minutes at the same level and really light volume. I don't think it's going to go down. I'll make the bet that it's not going to go down. So aggressive play would be to buy it here. I'm sorry. Let me say this again. Let me say that again. Aggressive play would be, no, it's not that aggressive. You can buy anywhere. It gets a little sloppy down here on bar number 2. You might get stopped out if your stops are too tight. If you do, you go back in and you see this double 5-minute bar, both of them going up. It's pretty good indication it wants to go higher. Why it comes back down is because of the high volume. So anticipate that. Whenever there's high volume like this, whenever the volume pops up like this, anticipate it being tested. Sometimes it doesn't always get tested. Frequently it does. So you can buy either of these. I wouldn't buy this. That would be aggressive, even with all of this in the background, but I would buy that. That's nice, that last little bar there. Hang on a second. Am I reading this correctly? Yeah, I am. Okay. So, no, I'm not. 1, 2, 3. I'm sorry, I got to get this right. 1, 2, 3, 4, 5, 6. 1, 2, 3. I guess it is right. I apologize. That is right. I thought this is unusual to have a high volume bar like that, but it is correct. So again, I don't like to just do this naked. I want to make sure that I've got something at least behind me, and I do. I look here. This is right where we are, right here. And I'm on top of yesterday's high. If I see this on top of yesterday's high, I'm happy. I know the rest of the morning at least is going to most likely be up. Okay, let's see. That small bar with large volume after 3. Why? Yeah, I don't know why. I don't know why. Could be algorithmic trading there. Most likely it's algo trading. These high volumes, a lot of it is algorithmic trading, but it doesn't make any difference on this. If you don't want the algorithmic trading and you want to trade the financial futures, trade the YM, the Dow. So here's a monthly bag holding. This is on the 10-year note. You can see, I just focus on this. You can see the high volume coming in, narrow range. Nothing really to the left of us for months on end here. So that's bag holding, right? So again, we wouldn't necessarily go right in on it. We'd want to look at, since it's occurring on the monthly, we could check the quarterly, but I also want to see what's happening here on the weekly. And we see some buying coming in, some no supply here on bar 3, leads to more buying. Some selling comes in, but again, here's a test or no supply, if you like, or a key reversal. It doesn't really matter what we call them. as long as we can see that the market's not going down and it's poised to go up. And we've got bag holding in the background. And so this is what it would look like on the daily. This is 3 down here. This is 3 in here, 4 and 5 on the weekly. I should have labeled these. I apologize. But you can see this is the entry right there. We come down. You can even tell that this is holding in here and not coming all the way down. You get the clustering of closes across here. We dip down once, no volume is brought out, and it immediately reverses. So you've got a test after buying has come in, bag holding on the higher time frames, and good indications that we want to go up on the intermediate. What's the difference between bag holding and churning? Churning occurs with a lot of this up and down. It's like a tight trading range. Bag holding is just going to happen on 1 or 2 bars, and it's very high volume. Churning doesn't have to be high volume. It's just up and down, back and forth, back and forth. There's some churning in here. I mean, you could call this a little bit of churning. What you're seeing is the weekly going up and going back down again. So the weekly is churning a little bit in here. Right. But I don't know, what is churning never really tells me anything. So I've never really thought about too much about it, except that there's just a lot of activity. Okay, so we've been going for 2.5 hours, and I'm on slide 66 out of 80. Shall we keep going, or do you want to take a 5-minute break here? I'm fine to keep going, but it's up to you guys and ladies what you want to do. Keep going or take a break? I got majority or keep going. Yeah, everybody's saying keep going. Okay, I'll keep going then. So top reversal. This is very common. It's a 2-bar pattern. The first bar is marked up rapidly, closes near the highs. And if the volume is high, we call that hypodermics. And that typically comes from Wyckoff, describing market action as a very ill patient who's lying on the operating table, and the physician decides to give him a hypodermic of adrenaline. So they give him a shot of adrenaline, and he jumps up on top of the operating table and dances a jig, and then dies. Proceeds to expire. So that's what hypodermics stands for. Excessive action on a bar that's suspect because it's so high up there and so far outside of the trend channel. Okay. And if volume is low, then it signifies no demand. The second bar, remember this is a 2-bar pattern, comes down right away with widespread, and it should encompass most or all of the first bar, and closes on or near its lows. Now, if the high is higher than the first bar, in other words, if it went up above the high of the prior bar, couldn't hold it, and then came down, that adds to the weakness. And if the close is lower than the low of the first bar, it also adds to the weakness. So you can see it right there. We're going up and up and up, and even in this, we're accelerating. It's a little subtle, but you're going up, and then you're going up, right? So you're accelerating. The stride accelerates. This is actually climactic, and we frequently see top reversals at climactic action. The first bar goes up on high volume, hypodermics. Second bar reverses, comes right down, encompasses most of the other bar, closes on or near its low. If it goes up higher than the first bar and closes lower than the low of the first bar, that's really strong, but this is pretty strong itself. Okay. Do I use the 310 anymore? No, I don't typically use it. Again, I want to know, is this climactic action? It's outside the trend channel. We're on a daily chart here. It's outside the trend channel, so that suggests weakness in and of itself, and then it comes back inside. That's also weakness. But where are we? Well, if we look on the monthly, we've got, this was support in here earlier. We went through it, and just as I said before, this should now be resistance, okay? So the higher time frame, the monthly chart is saying, watch for something to happen here. And the weekly is on a trend, and it's on a tear, right? Because this has been coming down and down and down for months and months and months, years, and now we're on a tear to the upside, and now we get this top reversal, climactic action in here, in the higher time frame resistance. That sets us up as a choice top reversal, okay? And this is the result so far on this. We haven't made a trade. Here would have been the first entry on this. And you might still be short, but we haven't finished this. Notice that we've come outside of the trend channel. However, we might not still be short. Let me back off that comment for a second. I forgot something here. On the monthly, look over here. We're not too much farther down. We're a little farther down here now on the monthly. We're maybe in here. We've just broken the downtrend channel. I don't anticipate this to, I mean, that would be significant. If it comes back into the downtrend channel, then, you know, all bets to the upside are off. But we may very well come in here and test this vertical acceleration bar. We call these vertical acceleration areas, okay, or bars, vertical accelerate. There's another one right there. And we typically come back up into these areas and test them, or down into these areas and test them, as we've been talking about. So we're aware of these vertical acceleration areas. This is all buying, and so if we come down, we're looking for testing to go on in here and for an opportunity maybe to buy. So this climactic action is in a little, in contrast with what's going on in the monthly. So we'll have to see how that works out. Does the monthly come back in, or does the monthly hold? And that's what I'd be doing on this. Okay, so here's another example. This is just in the daily. We have tremendous supply. This is the Dow. And as I say, if you want to avoid the algorithmic churning, they don't do it that much on the Dow. You got a lot of volume coming in here on the move down, the recent move down that we had back in February, back last year actually. Was this last year? Yeah, I guess. Yeah. And we rally up, and then look at here, we come up and we have the first bar coming up on low volume. So that suggests no demand, and it's preceded by this bar here, A, which is less than the previous two up bars. So that's no demand coming in as well. Second bar goes up higher, almost comes down, closes on its low. That's good. Almost closes underneath. Or maybe this is a little cockeyed, and maybe it does close underneath. I'm not quite sure. Certainly the next bar does. But since it's a top reversal, it's good enough to go short on right on the close, and we can do that. Then we get bar B. Bar B has increased a little bit of increased volume, not over bar 2, but over bar A. Okay. Now, why is that important? Because we're back in the area of bar A. We saw no demand here coming up, and now we have supply coming down. So this B tells us that the no demand is actually correct, and that we don't have to worry about any buying coming in when the market comes down and then continues to go lower. Any questions on that? Just one more example here of a top reversal coming in. Here we wouldn't take the top reversal, although this is also climactic. We're outside the trend channel here. We come down, we rally up a little bit. On bar 3, we get the no demand. And bar 4 is a weird one. A lot of volume comes in, effort to go up, no result, and then it comes down, and it comes down hard. Not so much in the volume because it's kind of eclipsed by bar 4. It's hard to know what's going on there. I can't imagine that was a lot of buyers coming in and selling swamped it. It might have been a block order or something that they put in there. Not really sure. Or it could have been a lot of churning. Maybe people were thinking this was going to go higher. Maybe there was news on it and sellers were in there selling. And so we come down to 5, and then we get this hidden up thrust in here on bar 6, and that would be our entry. Why do I say I wouldn't enter in here? Well, because on the weekly, I might up in here, but that bar 4 would have kind of maybe pause. But in any event, we're still up above support here, and I want to see weakness come in, and we don't start seeing it. We see enough of it by the time bar 6 comes in. The other trades are, you know, the signs are there for them, but they're a little, in my book at least, they're a little more aggressive. So I would say that the play here is right here. And again, I'm not interested in getting the tick high here, you know, up in here. I don't mind missing this because why? Because I get all of this. Look at that. There's no selling in here whatsoever. I'm sorry, no buying in here whatsoever. This is all supply until this bar here. We see a little shortening of the thrust here. Kind of gives you a heads up. We're at support. This would be a good target. After this kind of a move, this is where you would exit. You get a nice trade off of this. That's the kind of trades we look for. You know, a lot of times we go in, we're fishing a lot of times. We might go in on this and the market reverses back up, and it might cause us to take the trade off or, you know, cut it or what have you. But occasionally we get those large ones, and those are the ones we want to hang on to because those will make the month, or those will make the quarter or the year even sometimes. So bottom reversal as a sign of strength. Again, just like the top reversal, very common. Down move will be underway. I like to see 4 bars here of down move. We don't always get that, but I do like to see it. Again, first bar is marked down rapidly. Second bar rapidly reverses up. It's just the opposite of the top reversal. And again, if the low is lower than the first bar, it adds to the strength. And if it closes higher than the first bar, it will add to the strength. So we just had a bottom reversal a couple of weeks ago in the S&Ps, and one also in crude, which looks similar. But this is your picture-perfect bottom reversal. We're coming down and down and down and down with no relief. Suddenly, look at bar number 1. Look at the volume. We're coming down and making progress, but what happened to the volume? Then we go underneath, we rapidly reverse up and close firm. Well, that's a bottom reversal right there. Okay, and a nice one. So should we be thinking about that? You know, as this market's coming down? Well, yeah. If we look at the weekly, we're way oversold down in here. X marks the spot. We're way oversold, and as we're down here, we've got low volume. This volume didn't come in until we start pushing up, so the volume was probably down in here somewhere when we were down in these lows. So we would be very aware of what's going on if we're looking at both price and volume. We'd also be aware that we're way oversold in this trend channel, and that we're plummeting down in here. And this looks like climactic action to me, but the volume doesn't comport to it. So it's an oddball one, but it's a really, we get saved, I guess, by the if you want to put it that way, by the daily chart. But it's the weekly that tells us that here's the conundrum that we face in this. It's the weekly that tells us this kind of setup is likely to occur, or something along this line is likely to occur, and it will be good. And it's this setup that tells us that this is actually true. So we're going back and forth simultaneously, and that's what creates sometimes some confusion and sometimes some difficulty. But it's, yeah, it could be the lower volume on Christmas Eve. Yeah, that's right. But it's the whole week that was low as well down in here. So it was a little bit more than just that. And whatever was climaxing was actually happening here before the actual move, before the bottom reversal. Okay, here's another one, a 2-bar bottom reversal intraday. Now, there are people in here from all over the world, including folks that are in Europe trading the European session, and some folks in Japan and Indonesia and Singapore, Malaysia. I've got clients, and New Zealand and Australia. So I purposefully picked this period of time out. This is 3 o'clock in the morning my time. This is in the middle of the overnight for me in the S&Ps on a 5-minute chart. So it's a little scratchy in here. It's not as clean as you see on the day during the American session, because the American session has all the volume. But we're coming down, and then we get the bottom reversal. We didn't go quite underneath, but we close up above, right? And then we get, it's followed by no supply and a key reversal bar. And there's either of these is your entry, either the no supply or the key reversal. We get more no supply, 2 bars of no supply here. You could enter again in here or here, this being the better one. And then because you've got supply over here, it's unclear what's going to, looks like it's the open of the European session, or getting in, yeah, right after the open of the European session. Another opportunity to buy in here. So I'm sure all days aren't like this, but you get that strong signal, and then all of that starts to happen. So does this really make sense? You know, we always got to go back to that higher time frame. And here I am, I labeled this area A on the 5-minute chart. Here's the 60-minute chart, which is the 5 minutes higher time frame, one of them. And what do I see? Well, I see what preceded this yesterday. This is the session break here. So everything to this side of the line is yesterday. Everything to this side of the line is today and what we're trading. And what I see is a bottom reversal on the hourly, with great volume coming into the upside, saying that there's a lot of demand. Then it gets tested in the overnight. This is a nice test bar in the Globex, or the overnight, and it rallies up a little bit, and then it comes back down. And what does it do? It's testing the overnight at this spot right here. 228, 26, 2628, 2628, right there. Okay? So again, we see that the higher time frame adds to our trade, and it adds to the confidence that we can take. We see the bottom reversal occurring, then the no demand, and the key reversal after we've hit the overnight low, and we're pushing up off of it after a 2-bar bottom reversal with good volume that gets tested from yesterday. Towards the end of the day, I want to be a buyer here. And this is all occurring before the American Open, well before the American Open. Okay? Okay, so that's the end of the signs of strength and the signs of weakness and so on and so forth. Obviously, what I'm teaching you here is multiple time frame trading. And the higher time frame locations of interest, where we want to look for trade possibilities into new or high or new low ground. We talked about capping the market and climactic action, both buying climaxes and selling climaxes. You could probably put bag holding in there too, but I see bag holding a lot more frequently inside the market rather than outside, into new low ground. So if you see it, be aware, be alert to it, but it doesn't have to go into new low ground. Higher time frame support and resistance, we've seen that numerous times. The up thrusts and the bottom reversals and other things occur off of that. Higher time frame trend channels, we've got a line, if the market's going up, we've got demand line and supply line. Oh, either way, if the market's going up or down. We've got, the trend channels where demand will come in or where supply is expected to come in, either up or down. Areas where we are interested maybe in taking a trade. Higher time frame areas of prior supply or demand, those vertical acceleration areas where typically we come back to the halfway point of those for testing. Could be a little higher, could be a little lower, but generally we come back into those vertical acceleration areas, which are defined by the widespread and high volume and accelerating price, either up or down. So we want to come back into those later on and test to see if there is still more demand or supply there. And the higher time frame indications themselves. If you get a higher time frame sign of weakness, like we've seen the monthly top reversal, or a higher time frame sign of support, like we see the daily bottom reversal that sets up, or the 60-minute bottom reversal that sets up the 5-minute trade. Okay, those are indications in and of themselves and should be respected, or we want to be alerted to. So in addition to the slides that I sent out a list of the ways that we've used Wyckoff in the multiple time frames here on all these different trades. So for example, and by the way, on the second page, I don't have it here, but on the second page, I have all of these little KR and HUT and NS. I've got a little legend that defines them. So HTF is higher time frame. So getting aboard a higher time frame trend is the very first thing we talked about. Talked about the 65 combo, the use of the lower time frame, no demand, no supply tests, hidden up thrusts, minor climaxes, and key reversals, right? We talked about market turns, the lower time frame upthrust into a higher time frame weakness. So we looked at a weekly upthrust into monthly supply, into the vertical acceleration areas, and then we had the entries on the dailies. Okay, we had a lower time frame buying climax into higher time frame weakness. We saw the daily buying climax into evidence of supply on the weekly, or the weekly buying climax into quarterly resistance with entries on the daily. So all of this is laid out for you, and I would encourage you to study it, and you can then create your own trade setups from this. But this gives you kind of the details of my thinking, my conceptual thinking about how to pair the higher time frame buying climax with the no demand and the poor closes and the effort versus result and so on and so forth. Okay, that should be useful for you. So let me end with just a few suggestions about this. I've given you a lot of detailed information, and I would encourage you to review it. You might have to review it a few times before you start to get it down. You can take notes and stuff. We sent out the charts that you can do, or you can take screenshots and stuff for yourself. But review what I've got. Get it clear in your head. Make sure you understand. And if you have questions, the email is easy to you can either go to the website or directly to me at Dr. Gary at tradingpsychologyedge.com. And I'll just say, I got a question from the sign of weakness, sign of strength webinar. Can you help me out? And I'll be happy to do it. May not get to you right away. It may take a day or two, because I do get a lot of emails and I am pretty active, but I will get back to you. Okay, so that's the first thing to do, is to go back through and review the webinar. Then set up your charts. So if you're a day trader, your higher time frame is going to be the daily and 60-minute charts. And your 5-minute or 10-minute will be your trading time frame, your lower time frame. Every so often, take a peek at the weekly, see what it's doing. Make sure you, because the weekly is going to drive the daily will drive the 60, and the 60 will drive the 5 or 10 minute. Okay, so every once in a while, take a look at that. A couple of times a week. Swing trading, monthly, daily, weekly. You're trading off of the weekly through the day, looking for the rational comes on the weekly. You're looking for evidence of supply or demand consistent with your weekly trade on the monthly. Then you're looking for confirmation of all of this on the daily, and then entry on the daily. Don't forget that confirmation. Don't just look for entries. Look for confirmation too. That's going to come in the no supplies or the no demands. Also, every so often, take a peek at the quarterly, and you will find the 240-minute chart. As long as you've got enough activity, say 6 hours of trading during the course of the day. So some markets, some of the markets like some of the commodities don't trade as much. So 240-minute, you're only going to get 1 or 2 bars of that. Then you drop down to the 60-minute. But on most things, take a look at that 240-minute chart. It's really nice for swing trading, and it will give you a preview of what's going to happen on the daily a lot of times. Position trading, you're going to trade off the weekly and use the yearly, quarterly, and monthly. Set your charts up that way. Review the signs of strength and signs of weakness in your markets, and understand how to start coordinating the time frames with your markets if you don't already do that. And see how they work in your markets, not the ones that we showed here. They may or may not be the same as your markets. But you want to get every market's going to be a little bit different. They all have a little personality, so you want to, the S&Ps are the markets that I trade the most, and I know, what's likely to happen in those markets. You stick with markets and you'll find that. Then practice. A really good idea. You can do it in a couple of different ways, a few different ways, and I would encourage you to do it all the different ways that I'm suggesting. One is, at the end of the day, mark up your charts. Identify all the signs of weakness and all the signs of strength, where trades were, how it coordinates with a higher time frame, exits, and so on and so, entries and exits. Also, that's one thing you can do, and you start to see this over and over again. You get good at it. Bar replay, if you have that on your software, that's a really useful tool. Set up your charts, especially if you can do it with multiple time frames at at the same time. Not every software does that, but some do, and some are really good at that. That's what we do in Deep Practice every week. You can join that. We keep the price fairly inexpensive. It's less than, I don't forget what Helen's got it priced at now, maybe 120 or 125, something like that at the most. I hope she didn't increase the price. I'll have egg on my face, but it's fairly inexpensive. We meet for an hour and a half every Thursday. Everything's recorded, so you can go back to the recordings and all of that stuff. But we do practice. We do exactly what we've been doing here, except for we're walking through historic charts bar by bar and placing trades, exiting them, adding to them, what have you, placing stops and all of that. So you can do bar replay on your own, or you can get it all amplified if you want and jazz it up by coming to Deep Practice and we've got a bunch of, we've got traders from all over the world there, folks who are fairly inexperienced all the way up to people who are more experienced than I am, who are trading funds and what have you in that. So it's a good time. We have a lot of fun, and people enjoy it. That's enough of the plug on that. So that's it for me. I thank you all for that, for coming to this and being interested in my work. If I ever write a book on the Wyckoff method, this webinar right here will be its foundation. So let me get to some last questions here, and then we can call it a night. What does LP stand for? Lower time period, lower time frame. Sometimes I use P instead of F. In futures market, is there very low volume? I work during I guess it's Eastern Standard Time. In futures markets, is there very low volume during Asian and European sessions? Yeah, definitely, except for the currencies. How to differentiate for intraday trading? Yeah, for Asian, I would look at the currencies, particularly the Japanese yen and the Australian dollar, maybe the New Zealand dollar. I don't know how actively that's traded though. I haven't looked at that. Also the Nikkei. There used to be futures on that. I haven't looked at that market in probably in years, but that might be useful too. But you can trade. I showed you the S&Ps at 3 o'clock in the morning. So if you're on the other side of the world from me, that would be during the Asian session. Not every night is going to be great, but there will be, you can still trade it. It's not as good as the American session, but that's all I can tell you. So Milan, hopefully that helps. If I pronounce your name even close to correct, and I apologize if I screwed it up. Yeah, I need to study time, repetition, and practice to sink in. Yeah, it's exactly right. It's like anything we do. If you're learning how to play tennis, for example, if you're a rank beginner, it's really hard. Or if you're learning how to play the piano or the guitar, very difficult to do. It seems impossible right off. But if you persist at it and you plug away, you start to see things, and suddenly you're reading music off of the guitar, whereas before you couldn't even press down on the fret and hit a note. It's the same thing here. You'll start to read this like music. Are tick charts useful in addition to time-based charts? Yes, Kim, they are, and I do use tick charts. And I'll tell you what they're useful for. They're useful for a couple of things. If you use indicators, then I would encourage you to think about trying tick charts, because they standardize the data by the data. They standardize according to the data, not according to time. So for example, I often use a 3000 tick bar in the trading the S&Ps intraday. So that's kind of like a 5-minute chart on an average day. On a very fast day, it might be like a 3 or a 2-minute chart, and on a slow day, it might be like a 10 or a 15-minute chart. Why is that? Because it's not dependent on time. The bars are created with the number of price changes that occur. And when 3,000 price changes, or trades, you can think of it that way, when 3,000 trades have occurred, it creates a new bar. It starts to go on to the next bar. So every bar is standardized to 3,000 ticks, and it's standardized not to time, which is meaningless, but to price action, which is very meaningful. So when you standardize it against price action, your indicators are going to be read against standardized data, and they're going to be they're going to give you better indications overall. So that's one reason to use it. I don't use indicators all that much. Occasionally the 310, I'll put it up. I used to use it all the time with religion, but I've gotten to the point now where I can read without that, and I don't feel like I need it. Keep in mind that if you're going to use an indicator like the 310, it will give you that initial condition. Just like on that very first trade setup that we talked about, the 65 combo, the 60-minute bar gives you the initial condition. You let it close, and then you turn your attention to the 5-minute bar. There you have to confirm that the 60-minute bar is strong, and you do that with the no demand or the no supply, the test, the hidden up thrust, the key reversal, the minor buying climaxes. Okay. Oh, I just lost my train of thought. That's not good. We were talking about the 310. We were talking about I forget why. Oh, the initial condition. So the 310, if it's given you, if it's, say it's pulled back down now to the 0 line, and that's the initial condition for a trade setup, say to the long side, you're pulling back. Now you want to confirm it with the price action. That's the problem with indicators. They give you the initial condition, but they never give you confirmation. I'm trying to teach you the initial condition and confirmation. So every time we go to confirm, we get the initial condition on one time frame and we confirm it on the other. Okay. So the other thing, though, Kim, that tick charts are useful for is trading in the overnight session and trading early in the day in the S&Ps. If you're just using a 5-minute chart, sometimes a lot of times there's not a lot of activity. There's more and more in the overnight in the S&Ps, but there still is not the same level of activity as there is in the American session. So you're not the chart isn't going to be really clean and clear. Tick charts compress all of that because it's not time-based, it's activity-based, and it makes reading the overnight really, really easy when you're coming in the next day. So yeah, I use tick charts, and those are the reasons why. LTP and HTP simply mean higher time period and lower time period. Higher time frame or lower time frame. All right, looks like everybody's ready to go here. We did send out the slides, Javier. If you didn't get, we check your email. If you didn't get them, drop me or Helen an email, and we'll get it back. We'll get it right out to you. Okay, that's it for me, and it looks like that's it for the questions. And I'm not going to look at the current S&Ps. I don't even have charts up at this point. And I don't have platform up or anything else. Everything is focused on this. Whoops. Looks like the internet is really iffy tonight anyway. So I'm going to end it here, and thank you all. I really appreciate all you coming in, and the questions were excellent. And hopefully we'll see you either in some trading venue somewhere, or maybe in deep practice, who knows. Take care, everybody. Thanks an awful lot. Bye-bye now.